Today we're going to talk about Chapter 12, Joint Interest Accounting. There's three legal forms of joint operations. You have your joint venture of undivided interest. This is the most common form you will see. They share interest in the entire lease. It may be created initially or it can be created later. You can have a legal partnership or a jointly owned corporation. The JOA is a joint operating agreement, and this is the document that gives the details on how the agreement will work. You have your working interest owners. The operator is usually the one with the largest interest percentage. You also have other working interest owners that are non-operators. You have the accounting procedure that's decided on. That's going to give the detail on how to account for the items. And the joint operating agreement defines the duties of the operator and of the non-operators. Some of the main responsibilities of the operator include managing all the developing, operating, and record keeping. The major expenditures obtain the written authority via the Authorization for Expenditure, or AFE, so this authority would be obtained from the other working interest owners. Periodic reporting to the non-operators, paying the costs and billing the other working interest owners accordingly. For the accounting procedure, the Council of Petroleum Accountants Societies issues the procedures and the guidelines to be followed. These procedures include the general provisions. It determines what the direct charges are for like operation, maintenance, drilling, repair, and rentals. So it defines what is allowed and how to account for it. It's going to give the agreed upon allocation procedure for overhead, what the operator is allowed to recover as far as indirect costs. It's going to detail the pricing for labor, employee benefits, and materials, and it's going to discuss how to account for inventories. In charging overhead, the most common method is the combined fixed rate. This includes the combined, which covers an operator's expenses at all levels, including the home office, like a corporate office, regional and district, and a fixed amount that will not fluctuate with the actual procedures. So this will determine the rate and it will stay fixed. So if you are only drilling and producing for one day, or if the drilling is going to be prorated. The joint interest accounting keeps the accounting records, and you would keep this for the entire property. You have the accumulation of joint costs in regular accounts, for example, lease operating expense, wells, and equipment. At the end of the month, these are credited, and you would record a receivable from the other working interest owners for their portion that they owe. So our first example is on page 525. Tyler Company owns 60%, South Company owns 10%, and North Company owns 30% of the joint working interest in Lease A. Tyler Company is the operator. As you can see, Tyler owns the highest percentage. Tyler Company incurs the following costs during October 2012 in connection with Lease A. So we have salaries and wages of field employees. This is going to be lease operating expense. You have contract service, again, lease operating expense. Purchase and installation of compressor unit. This will be wells and equipment. You have property taxes paid, would be lease operating expense. Equipment from the operator's inventory installed on the lease. That's going to be wells and equipment. And then you have the overhead charge that's allowed. For this example, there's 2 wells, and the agreed upon overhead charge is $1,200 per well, so that would be $2,400. So here are the journal entries that would be made during the month. So note that at first, Tyler's going to record 100% of the cost for the lease. So we have lease operating expense, joint lease, $5,000, credit wages payable, $5,000. As you can see from the previous slide, again, this is the entire amount. And then you have the amount for lease operating expense for the contract service. You have the wells and equipment, the lease operating expense for the property taxes, and the wells and equipment for $600 and crediting materials and supplies. At the end of the month, the operator, Tyler, would make these journal entries, going to record lease operating expense and credit overhead expense, so that's for the overhead amount that was agreed upon. Then he's also going to make a journal entry to set up the receivables. For South Company, it's going to be 10%. North Company is going to be 30%. And then you're going to credit the lease operating expense for the 40% and credit wells and equipment for the 40% for South and North companies. The journal entries made by the other companies, you have South Company is going to debit lease operating expense for their portion and their portion of wells and equipment of $150, and they're going to credit their payable to Tyler. North Company is going to do the same. Going to debit lease operating expense and wells and equipment for their percentage and credit the accounts payable due to Tyler. You may also have a non-consent working interest owner. If a working interest owner decides not to participate in a particular well, reworking, deepening, this is going to be referred to as a carried working interest. The interest temporarily reverts to the remaining working interest owners until the costs and a penalty have been recovered. And with the joint interests, typically you're going to have audits. So these are limited to examining the charges made to the joint accounts and support for those charges. And that concludes Chapter 12.